All right, thanks for waiting over the break. And now I want to encourage you all to use the Q&A function in our webinar that'll allow you to engage with panelists and many others throughout not just this session, but throughout the entire day's activities. At this point, I'd like to introduce Brent, who will introduce the panelists for the pandemic, what I've learned, and long-term impacts. Take it away, Brent.
Thanks, Kevin. Good morning, welcome, and thank you for joining us here today for our first Drake Risk and Opportunity Forum. As Kevin mentioned, we're going to spend the next hour talking about the pandemic. I'm guessing we could spend the next day or two talking about the pandemic if we wanted to, but we'll try and keep it to 60 minutes. As Kevin mentioned, we're going to talk about what we've learned so far and what we see as potential impacts in the insurance industry. You would think after 19 months we would know quite a bit about what we've gone through, but there's still plenty of unknowns out there. Always brings me back to my favorite risk quote: risk being all about the knowns, the known knowns, the things we know, the known unknowns, the things that we know we don't know, and the unknown unknowns, the ones we don't know. I would say, early in this 19 months, there were plenty of unknowns. There are still plenty of unknowns out there today, but hopefully we're starting to learn some things about the current pandemic we're in, and hopefully that'll help us make good decisions as we go forward. Today we have two great panelists with us today, both esteemed graduates of Drake University, and I'm happy to have them both with us today. Alyssa Kwan is the Executive Vice President, Chief Insurance Officer at Oscar. She has spent many years in the insurance industry on the risk management side. Our second panelist, Roy Ju, is a vice president leading ERM and actuarial functions at Prudential. Roy's had a variety of positions in the actuarial field in the life and the annuity lines. We have a series of prepared remarks, but we hope to leave about 10 to 15 minutes at the end for Q&A. So as Kevin mentioned, please send your questions into the Q&A box throughout the presentation here. We're going to start today with Roy. Roy's going to talk a little bit about COVID impacts to mortality, morbidity, policyholder behavior, and potential subsequent impacts on actuarial assumptions. So Roy, take it over.
Thanks, Brent. And I'll echo your comments about the unknowns and the knowns within risk. And for that reason, I'm going to keep a lot of my comments more from the rearview mirror perspective. And it's amazing to think all the way late October 21 that we're still seeing the dust finally, well, not even quite the dust settle on COVID and what that means for a lot of our key assumptions and key business drivers. And so for that reason, maybe I'll start first with a little bit of a forest above the trees approach. Some of the key assumptions, as Brent had mentioned, mortality and policyholder behavior experience. Approach that we took at Pru, as well as a lot of our large competitors within the industry, we recognize the substantial short-term impact for COVID, but we adopted more of a wait and see approach when we thought about strategically how we wanted to go about key long-term assumption setting and other kind of long-term applications like valuation and financial reporting processes. And so within that wait and see approach, I'll dive a little bit more into some of the thinking and mentality behind that, because I think that's a useful case study for any kind of severe risk or tail event that arises similar to COVID. But before diving into mortality a little bit more, I'm first going to highlight policyholder behavior a little bit. So what we saw in general is lapses being temporarily depressed in 2020 for most of our domestic lines. This was most notable within our annuity lines, our individual life insurance lines, as well as our long-term care lines. Within annuities, we saw a temporary decrease in advisor activity, the general churn in business, right, during the first few months of lockdown and that transition to virtual. Eventually that did pick up a little bit once that transition did occur. And I think by about 3Q, we saw lapses recover to near normal levels. So that did indicate the temporal nature of the impact as we had presumed. Within individual life, a little bit of a similar story. So there were state mandates that prevented policy lapsation for premium payment requirements that weren't being met. We expected that to reverse post-mandate, and that did. Again, indicating the temporary nature of some of these policyholder behavior shocks. And for that reason, we were prudent in not recognizing this for long-term actuarial and assumption setting applications. Long-term care, a little bit similar story, grace period mandates for premium payments, again, with the expectation of reversal post-mandate. Within our group, our retirement and our international lines, a lot of the experience was relatively emerging in 2020, pretty sparse credibility. Nothing too deep to read into there. So those were the more notable highlights within our domestic lines. Maybe dive into the LTC bit with the morbidity experience. But we saw a claim reassessment suspended a little bit through about early June, and that resulted in fewer claim terminations relative to recoveries. Our assumption was that the reassessments would catch up, as they did. We also saw face-to-face assessments being suspended due to COVID. So approval rates for that reason were a little bit higher than expected, but we did not see an increase in claim intakes. So again, overall, as we boil things down, as we think about potential impacts to our balance sheet and income statements and any kind of strategic reaction, what we really thought was it's best to not overreact and see how the dust settles before making any kind of bigger long-term changes. So I'm going to dive a little bit into mortality because I think it's an interesting case study. So mortality, as you can expect for your large insurance carriers, particularly heavy in your life annuity and retirement space, mortality is a key assumption, right? There are base mortality and mortality improvement implications. Small fluctuations in any of these can yield, hundreds of millions of dollars impact to your bottom line. For that reason, we wanted to take extra caution in terms of how we thought about this. So a couple of the key drivers we broke down as we thought about what kind of potential impacts could make sense for mortality. We thought about the nature of the fact that deaths would be accelerated during COVID, right? And so what that would mean is from a prospective standpoint, we would see a reduction in mortality. So that being a bigger concern on the retirement and your longevity risk for your annuity and retirement blocks. Another driver is lingering health issues from COVID-19 patients. And the expectation would be that would increase mortality, mostly in the short term and long term, right? The acceleration of deaths due to COVID-19, that's more of a short term time frame, right? So you can already see there's a little bit of a direction and time horizon for a lot of these different drivers. Hospital and care avoidance was another driver we recognized would increase mortality, particularly in the short term. We also recognized there would be changes in behavior and environment, which would cause an overall decrease in mortality, more from a long-term perspective. We recognize unemployment was another consideration that would decrease mortality in the short term, and as well as economic impacts that would increase mortality to the long term. So there's a lot of sub-facets within each of these drivers that I may not have time to go into, but feel free to probe in any kind of Q&A dynamic. But we really brought all of these qualitative factors to the table. We had a dedicated COVID and mortality research team, and ultimately we came up with, hypothetically, if we were to change mortality, what would our best effort indicate, both for a short-term and long-term perspective, and dividing that focus between our base mortality and our mortality improvement. We took that through a couple of committees, and really the key consideration was, how do we balance the fact that mortality is such a critical assumption we have with the estimation uncertainty that naturally arises when you have a once in a century type tail event like COVID. And long story short, we thought, well, I think it's good if we continue to monitor experience to validate how accurate maybe our qualitative assessments of drivers and our initial kind of, if we had to make a change, how accurate would we be before actually making any changes. So again, that goes back to the initial approach for both policyholder behavior, again, driven by a lot of the temporary dynamics I had explained, as well as for mortality. Let's not overreact and risk creating volatility within our financial statements until the dust settles more, until we better understand kind of prospectively how this will manifest. I think now that we're getting towards the end of 21, heightened focus will be on 2020, 2022 assumption cycles where we're reviewing 2021 experience. We also have that additional year of analysis for 2020. So a lot more to come. And hopefully that case study on mortality gives you a sense of a lot of the qualitative factors that are considered for a difficult exercise, like thinking about mortality in a pandemic, and also recognizing the tremendous amount of impact that, you know, changing some of these longer term assumptions can have for a lot of our different actuarial and financial reporting purposes. And for that reason, wait and see was the approach that we did take here at Prudential, as well as I think at a lot of large carriers.
All right, thanks, Roy. Alyssa, we'll go to you next here to talk a little bit about some of the operational or unanticipated coverage impacts that you've seen, as well as modifications you see coming up in the future.
Sure, thanks a lot, Brent. So I thought I'd touch first on sort of the health insurance industry, and then maybe a little bit on property casualty. So I think the thing that was interesting in the health space was that the impacts that we're seeing as a result of the pandemic really varied by year and by geography as we went through the course of the pandemic. You know, in 2020, the industry saw very significant reductions in what we'll call non-COVID utilization, right? Things went into shutdown. People were not able to access just regular care because the healthcare system really couldn't handle it, was overwhelmed, and had to defer a lot of more, I'll say, discretionary procedures, annual wellness visits, things like that, because healthcare workers were so overwhelmed in dealing with COVID itself. So we see the costs of that deferred care outweighing in some instances, but certainly netting off of the increased costs as a result of COVID. And we see a lot of that in 2020. As we get into 2021 and lockdowns start to ease, et cetera, we do see that utilization coming back up. The question is how much of it is a speed up, if you will, or of deferred care, right, of that coming back, versus are there longer term impacts, as Roy indicated, right, as an impact of having deferred care, right, in that people weren't going and being diagnosed early enough with some sort of chronic illness, and therefore it was not managed properly early on. So is it just a catch up? Is there a longer term impact as a result of deferring that care in the first place? So in 2021, we see a little bit more of that. We see COVID costs ebbing and flowing, right, depending on the waves of the pandemic. That's also clearly very within the US, geographically driven as well, because we see some of these spikes, like from the Delta variant, not really evenly mayonnaised, if you will, across the country, but in certain places, depending on what types of precautions are being taken for the public good. So these are things that we continue to watch the shifts of, and it's it's difficult to parse out how much is from, you know, pull forward of care that was deferred, how much of it is greater chronic illness, and what will really happen with COVID in the future, right? In terms of, will there be further waves, and what will the cost and implications of that be? I think the other thing which Roy touched on from the life and retirement perspective is, what are the long-term effects as well to people's healthcare from people who actually had COVID, right? And as people refer to it as long COVID, and will there be greater comorbidities? Does it exacerbate the comorbidities that people may have had? And therefore the healthcare that they need in the future will be increased. So that, I think, is something that the industry is watching, and we'll continue to keep our eye on. I think one of the other, to kind of shift gears a little bit towards the property casualty industry, you see a similar thing, right, in the timing of the pandemic. So in the very early days, right, there was a lot of focus on travel, event cancellation, like the real immediate things that were happening. And, So you would see spikes in certain lines of business and claims that people would be bringing, or in discussions around, was there coverage at all as a result of the pandemic? How good were the wordings and the policies out there around communicable disease? What is really the event? Did someone with COVID actually have to be there and experience it, or is a local or national government shutdown enough to create coverage, et cetera? So it started in sort of that travel event cancellation space. We quickly saw some impacts in supply chain. As people will remember, some of that was felt acutely from the supply chain that was coming from Asia, who was first hit by the waves of the pandemic. And there was discussion in the trade credit space. That's insurance for businesses against the debts that can't be paid by their customers or their suppliers. And so there was a lot of discussion around the economic impacts of, if the losses are really large in the trade credit space and carriers no longer want to provide the cover because the pandemic was continuing to go on, what would the impact more economically be? And so you did see governments step in and create a backstop to keep carriers in that space and to keep going. We saw a lot of that in Europe in particular. Then we started to see the shift over here, in the US. Auto frequency went down. People were staying home. They were no longer commuting to work, taking their children to school, et cetera. So we had a focus in that space. As the world went into a greater lockdown, we had the big questions around business interruption. What does it really take? Typically, you only have coverage if there's an actual insured event, which causes the interruption to your business. And is a national lockdown contemplated in that sort of thing, particularly when there was no disease on the premises, et cetera, and you're closed down and losing business as a result of the shutdown. We saw that handled in very different ways globally. The UK tried to handle it, as a one industry. Let's have a discussion. Let's take it to the court. Let's just settle it one time and be done with it. We don't have that availability of doing that in the US with our 50-state system around insurance regulation. So we handled it in different ways as we move forward. And I think that the arguments were slightly different because the wordings were different as well. Then we started to see the E&O claims come in for the brokers, for people who found that they had no pandemic coverage whatsoever. And why didn't they have it? And they didn't understand that. And then finally, one of the things that we see longer term coming through is in the claims activity in spaces like, for example, in workers' comp. Historically, according to the NCCI, medical only claims, that means with no indemnity, no loss of wages, accounted for about 75% of all workers' comp claims. But according to them, all of the reported pandemic-related claims with the payment or a loss reserve, almost 75% of them have an indemnity component with regard to those that are COVID specific. So that's a real shift in the underlying mix of claims, et cetera, that needs to be considered as the industry moves forward with regard to COVID and other pandemics of the same ilk that may continue as we go in the future. So I think there's, lessons learned in the industry around, focus on policy wording, the tightness of what people see there. Will there be different questions asked in underwriting in the future around the businesses that you're in, who your suppliers are, how is your workforce now arranged, right? Are they hybrid? Are they in person? That's going to impact the way in which people underwrite policies. And I just think this greater understanding of a lot of the interconnectedness globally, I think will also impact the way people think about their policies and the coverage that they need as they move forward. So Brent, I'll hand it back to you.
All right, thank you. Next topic we're going to talk about, and we're going to go around the horn here, is a little bit about the overall operational impacts that we've seen to our businesses and our workforce talk a little bit about each of our organizations' return to work and some of the additional workforce flexibility that we've seen. You know, this is a virtual conference. I had started to see some conferences go back to in person, and that we've seen some of those shift back to virtual this summer as well. So, Roy, we'll start with you to maybe talk a little bit about what you've seen at Pru from operational impacts.
Yeah, absolutely, Brandon. I'll keep my comments a little bit limited and recognize that when I first say I'm talking about a large multinational firm in the Northeast working down in the Southeast, currently somewhere in between, not at home or work right now, doing this presentation. So I think the first thing we need to recognize is operationally, just as a whole, we got very lucky, right? So we had business business continuation plans existed and they were in place. But this pandemic was nothing like we had expected, right? A lot of these kind of catastrophic events are maybe just market, interest rates, equity markets. Here, totally different story, right? Folks are staying home. Pandemic is a lot different than a lot of our tail events that we plan for. And so even when indexing against events like the 1918 Spanish flu, COVID was a completely different beast in a lot of different dimensions. And so one thing to recognize is if this pandemic would have happened 10 years ago, even 5 years ago, before Zoom and Teams, likely as a whole, this industry would be in trouble, right? And so moving forward, folks at Prudential still are working from home for the large part. And we recognize that a hybrid model is probably the best plan of attack, but also recognize the inherent challenge there. We know we can do 100% in person effectively. We know now we can do 100% virtually with strong productivity. The question is, how do we manage both, right? Manage the culture and kind of the traditional work setting and benefits that we get when folks are in person, while also recognizing now in this new norm, it doesn't make sense to bring everybody back just like in the traditional form. And so we're currently thinking about what the hybrid model is going to look like. But again, taking a step back, it is important to recognize how lucky we truly are. Timing this exactly when Zoom, Teams, and all those capabilities did enable us to be successful virtually. So a little bit of a to be determined here up in the Northeast.
Alyssa, how about your operations?
Yeah, so I'm going to talk a little bit, I think, about kind of some of the business continuity, right? We always plan for business continuity, but a lot of the planning that goes on at organizations is around more of like a natural disaster or maybe a lack of power that would be there, et cetera. So I think planning for the pandemic was very different. And in the early days of it, right, when things were first coming out about what was going on in China, et cetera, I was at a large multinational. I was at AIG. I was at a large multinational, and figuring out when is the right time to close the office, right? Is that really what we're going to do? We were a very much in person. The people that worked remotely were few and far between, really, right? So we were very much an in-person company and industry, as I think many of everyone on here would probably attest to. And it was like, how are we going to do this and how are we going to do it overnight? We had talked for years, right, about decreasing our real estate footprint, saving money in that way, letting more people work remotely, et cetera. And now we were in a situation where it was becoming clearer and clearer that we were pretty much going to have to do that overnight, right? We didn't want to have to do it overnight, but we wanted to do it in a really thoughtful way. And there were a lot of things and considerations that were very different. When you're planning for a natural disaster, et cetera, a lot of your planning is, how do I get the business, the building open again, right? How am I going to get the contractors in to clean up the mess from the water or whatever the case may be? And this was a lot different, in that regard. This was about health and safety. This was about, are there people that will need to come in? How do we keep them safe? Can we get enough masks? Can we put plexiglass up? What are going to be the rules of the road in order for us to do that? How are we going to do it? For those that we're sending home, does everybody have equipment? Not everybody was a remote worker. Not everybody traveled. Not everybody had a laptop, right? We had employees in countries that don't have broadband internet access in their homes. And there were huge logistical maneuvers that had to be done with local telecom companies, local law enforcement, regulators, et cetera, that said, hey, we'll pay for it. You got to get these people broadband access somehow, right? How do we, we got computers in the office. Are they encrypted the way we want them encrypted? If they're going to go sit in somebody's home, how do we get that done before we can get them to people's homes, et cetera? How do we make sure the people that are in call centers and have to have the telephony in order to be able to still do that from their home environment, et cetera? How do you get that set up? So the planning was very, very different. And it was also different because it was for, I think, while we didn't know exactly the length of time, we knew this wasn't a 5-day cleanup, right? This was going to be a longer term. How do we make this happen, and how do we make it sustainable? And then, is it going to work? And how do we monitor, is it working or not? Like, we don't want to wait for the complaints to come in, or we don't want to wait for the operational failure that results. And so the planning for a lot of that monitoring, I think, was very, very important. So, I think Roy's points are very valid about sort of the future and as we go, but I think if lessons can be learned, from a risk management perspective, it's around the breadth of business continuity planning that's really required for a number of different scenarios. I'm sure people have taken a look back and said, a lot of things happened like we thought they would, and a lot of things didn't, or wow, we hadn't really thought about that in the planning that we had done overall. So I think it's always a great opportunity to take that step back and look at how it went. We're still kind of in it, because now I'm sure all of our companies have major discussions that we refer to it at Oscar as the future of work, right? What does that look like? How are we going to bring it back? And that's just as much, if not more work, right? In terms of how you get that sort of return to the office. Certainly don't refer to it as return to work, because everybody's been working the whole time. But I think a really important thing for us to all contemplate as we think about managing that go forward risk.
Yeah, thanks. I'll provide some perspective from a Salmons Financial Group lens. We operate in 4 locations in the Midwest. And again, as Alyssa said, we worry about tornadoes, floods, snowstorms, fire, things like that. And so certainly, I think, as with everybody, our plans didn't contemplate a 19-month outage, where the buildings were still standing, the infrastructure was still there, but it was more of the people that was the issue. I will say we have successfully returned our staff to office in each of our 4 locations. We've been all back in the office since August. Not to say that we don't still have challenges. We went back to requiring masks in the office a couple of months ago when the Delta variant started to spike. And so again, we're not back to normal. But for the most part, we're back in the office. I remember in the early days, we had shift A, shift B. If you were lucky enough to be on shift A, you could do your work during the normal business hours because we had concerns about bandwidth and whether or not our systems were going to be able to handle 1,500 people working from home. If you were unfortunate, and a lot of the actuaries were, to be on shift B, you got to work at night. And so we did that for a couple of weeks before we realized that we thought we could handle everybody being on at the same time. Our RTO process took a lot longer than expected. It was probably a 12-month process. We started, we stopped, we started, we stopped, and hopefully we don't have to stop again. But it is pretty amazing to see how well everyone has been able to react and how businesses have been able to keep moving forward, especially in the insurance industry. It's been an interesting case study that I'm sure many people will spend years looking at the organizational impacts to this event. The other thing too that I'm guessing all of us had to work through was impacts to our third-party providers. We have plenty of third parties that we utilize from a consulting basis. And we had some situations where we had some third parties that were out of service for a while because their plans maybe weren't as robust as our plans were. And there, as Alyssa said, some of the infrastructure challenges to some of the third parties had a bigger impact on them than they did with us. But 19 months into it, I think we're hopefully getting back to better shape. I think the flexibility, Roy, you mentioned a hybrid model. We've added some additional flexibility with our companies, and we'll continue to monitor that. I think that's emerging. What does the workforce of the future look like? I think that's going to take some time to figure out as well. We know that the people that have come back into the office are happy to be here, happy to be able to interact with others. But we also know that opinions have changed too. There are plenty of people out there that I think prefer to have a little bit more flexibility. We've all shown that we can operate from home effectively. But I think from my perspective, it is really great to be back into the office. We'll shift gears here a little bit again and talk a little bit about regulation. And from the perspective of how has regulation impacted our businesses over the last 19 months, and maybe a little bit about what kind of regulatory change do we think we could see going forward as an impact or as a result of the pandemic. So Roy, we'll start with you here to talk a little bit about what you've seen from a regulatory perspective.
Thanks, Brent. Yeah, in general, so I'll caveat that the lines of businesses I oversee are your life insurance, your annuity, your retirement, your group insurance, as well as long-term care lines. Things were a little bit more quiet, so I'm sure Les is going to have a little bit more extended dialogue on her end. But I did allude a little bit to this before. We saw within the annuity lines a temporary decrease in advisor activity, causing a depression and lapses. And that was pretty parallel to some of the regulatory impact that we saw on the ILI and LTC side. So on the ILI side, we also saw policy lapsation decrease similar to annuities. And that was driven by state mandates that prevented lapsation due to premium payment requirements not being met during COVID-19. Again, that did reverse post-mandate, and we did not reflect that for any kind of longer term assumption setting considerations. Long-term care, very similar as well. So you saw some intervention implementing a grace period mandate for premium payments. And again, all of that kind of causing a little bit of your traditional depression of key policyholder behavior experience. So I will contrast that with, you think 08, 09, where you have a lot of your more kind of market crash type tail events, where you see lapses drastically spike, right? This is completely different and in opposite direction. And I guess maybe before I pass the baton, one thing to mention, having sat through a lot of meetings with NYDFS and JDOBI, there is a heightened focus from regulators in terms of, okay, 2020, most companies had to wait and see, wanted to see how the dust is settling. Now that we're close to the end of 2021, dust has not completely settled, but 2020 now is in the rear view. And a lot of companies now have a better perspective in terms of how to appropriately consider and interpret the experience that manifested in 2020. So we are getting a lot more pressure to think about to what degree should we be introducing COVID impacts for key assumptions like mortality. And that's something that I think is going to be an ongoing discussion. I think there are a lot of different ways to reflect COVID, even without fluctuating your long-term valuation or financial reporting assumptions, such as through, you can think pricing, you can think shorter-term tactical application. So that's something we're currently working through to think about how we want to be prudent in reflecting COVID without rocking the boat too much and avoiding any kind of unnecessary financial volatility due to changing some of those longer-term assumptions.
So I would say, look, I think in the people, I'm sure everyone has an auto policy. People understood in the early days here in the US that a number, if not all, of the state regulators, did implement some rebates, if you will, for the much lower frequency when people were in lockdown and not out there able to drive. There were other requirements, as Roy alluded to, in terms of grace periods with regard to premium payments and that sort of thing, particularly for mandatory coverages by individual consumers in that space. There were definitely companies who made individual decisions on how to handle that with small businesses, et cetera, not necessarily, sometimes mandated, but not necessarily. I think in the healthcare space, we saw a lot of action. And I think net, there were favorable interventions and less favorable interventions. And it wasn't just regulators, but it was also legislators in the states and in the federal government that really had an impact. And so we see that there were a lot of restrictions that needed to be lifted around pre-authorizations, the fact that you could refill your prescription for a much longer period of time than you would have otherwise been allowed to, so that you could limit the number of times you needed to leave your home in order to go to the pharmacy, et cetera. And so I think that was very, very helpful to consumers. There was a lot of waiving of cost shares, waiving of deductibles, co-payments, particularly focused on COVID. So whether that was COVID testing, treatment for COVID, and then ultimately the vaccine as well. So there was a lot of that went on, and there was not only federal funding for the vaccine in particular, which was very helpful, but there were also all of the what I always refer to as the mass vaccination sites, right, that FEMA set up, et cetera, which the federal government funded and helped defray a lot of the costs for the consumer, as well as the health insurance and healthcare industry, in fact. We also saw that from I'll call it a legislative perspective, although I realize not all of these get passed through legislation. Sometimes these are executive orders. But the degree to which a state or local community is put into lockdown, the degree of mask mandate that is there, has a significant impact on the spread of the virus, and thus the cost of managing the healthcare outcomes related to that. So we see that vary quite a bit geographically, but that's definitely an impact that you can see based on decisions that government officials make. I think there were, like I mentioned earlier, other ways in which the government just, focused on the consumer itself. So with the American Rescue Plan, there was the increased special enrollment period, which would typically be very short, but because of COVID, Biden and the administration wanted people that did not have coverage to have the ability to get coverage without a life-changing event, i.e. have a child, get married, change your job. And so that created the opportunity for people to buy healthcare through the Affordable Care Act and on the exchanges for a much longer period of time. And in addition, they increased the subsidies so that people in lower income bands would have a larger subsidy and have healthcare be more affordable. So there was a real push by the government to make sure that in the midst of the pandemic, people would be able to actually get the care that they needed. So I think those are real, as you can see, there's favorable and kind of less favorable, but for the majority of them, they were very focused on the consumers and those that really needed the healthcare in the first place.
All right, thank you. We're going to move into our Q&A section here. If you have questions, please put them into the Q&A chat here. Roy, a question here for you related to long-term care. Question, I'm seeing a lot of interesting innovations around combination products. How do you see combo products leveraging services and technology impacting the long-term care market?
It's a great question. And one of the reasons that's a good question is because LTC is an interesting beast. For a lot of your large carriers, we see LTC as a little bit of a headache, a little bit of damage control, thinking about how maybe this was mispriced decades ago and how to make sure it's less punitive to our bottom line. But I think we also recognize qualitatively within society how important long-term care is, right? Especially as you see folks living longer, some of these longevity riders and value proposition that LTC brings is important. And so I think combination products and the new wave of innovation is going to be key because, again, this is something that's key for society, but it's just been a problem with pricing it effectively and effectively understanding the risk. I think now that we have more experience and look at things in the rear view, combining this with other products not only can give us synergistic utility and add that value to the customer, but I think we can also kind of price more effectively, subsidizing what could be kind of inherent margin and, let's say, annuity product while adding the LTC benefit. So I would agree, combo products with LTC, I think, is a good way to retain the value proposition LTC brings in a competitive way to a consumer base that needs it. And I don't want to come off as presumptuous and insinuating I know what what the answer looks like for those combo products, but certainly it would be interesting to see a new wave of, even LTC components to an annuity product or other, other lines of business. So I think that's a great point, and I do think that is on the horizon. It will be interesting to see how things unfold, but I don't think LTC is going anywhere, especially with aging nature of society.
All right, thanks, Roy. We got a question in here for, well, all three of us can take a stab at it here. Appreciate the discussion, reflections on business continuity planning. Can you comment on structures you may have had in place which were created specifically to adjust on the fly or address scenarios not contemplated? What might you recommend to include in updates to continuity plans, perhaps communication structures or key personnel assigned to action teams? Alyssa, I'll pick on you. I'll go alphabetically and pick on you here first. Sorry.
No problem. No problem. It's a great question. So some of the things that we found to be successful in the early days in particular was that we actually had to stand up multiple teams in order to, one, monitor and keep up with the information that was coming, the changes that were happening in local, by local governments, law enforcement, right, around like all the lockdowns and those sorts of things. And that was really important given the very broad footprint that we had in kind of 90 countries. And there was no way that one command center could actually take care of what it was that we would specifically need to do and by what time in each of those individual places. So we did set up more of I'll call it decentralized group, but that fed the information back kind of to parent, if you will, so that people had clear context and continuity and understanding of what was going on. And it allowed us, because the pandemic kind of came in a wave across the globe, if you will, right? Remember, it started in Asia and then it kind of moved to Europe and then it kind of came to the US. And it allowed us to be much better prepared in the subsequent places because we were very focused on it in some of those early waves. So I think that's really important. One of the other things that I would say that is kind of a lesson learned as you go through these is when the end is not in sight, or you really have no idea of where it's going and when it's going to end, you learn pretty quickly about how to communicate to people around the way you're thinking about it, so that one, they are kept informed, and two, they can also plan, right? And I'm sure everyone sort of experienced this. People were like, well, when are we going to go back to the office? I'm single. I live in this tiny little box apartment in New York City. And so I've gone home to live with mom and dad so I can have a little bit more space while this is going on. But I need to plan for my future. Do I keep my lease? Don't I? When are you going to call me back? And thinking about your employees and those sorts of things and finding ways to communicate that allows flexibility for the company, but then also gives them a sense of the ability for them to plan, changing your wording from like, we're going to go back in March to we will not go back before a certain date. That allows them to sort of at least know, okay, I'm good for the next 3 months, but I need to be thinking, and we clearly, you can't wait until the day before to say, oh, now it's going to be another 3 months, right? So I think there's things like that can also be done in order to allow people to plan as they move forward. But I do think that one of the other, to the individual's question. The other thing about who should be involved as you're doing the planning, I think does vary based on the situation that you're doing your business continuity planning for, right? So like I said, with the pandemic, there's a lot of health and safety and other issues like that versus, I'm recovering from a tornado, which is I have to rebuild a building, and I'm much more focused on how I actually get the structure back up and make sure that it's secure, et cetera. Those are very different people and resources that you need to pull to the table to help you answer the questions on how to deal with that situation.
Roy, anything to add there?
That was comprehensive. So having moved companies a couple times the last few years, I can't speak too much depth. So I'll pass on this one.
I think the only thing I'll add is I think what we learned is, we focused our original business continuity plans on what I'll call the mission critical functions. I think we've learned in a pandemic that everything becomes mission critical at some point. And so we'll take a broader viewpoint of things going forward than maybe we have in the past. Here's another question here. How are companies handling bringing in new employees in a virtual world? Feels like for established firms, onboarding college grads or even younger professionals is tough in a virtual world, as they need to see or need more guidance and mentorship and training. Roy, maybe I'll have you kick that one off.
Yeah, this is interesting because, first I'm going to take a step back and mention within this return physically to the office, generally companies have some kind of overarching enterprise guidance, right? Like even if folks want to work remotely 100% of the time, maybe they need to come in once a month at least. At least that's what Pru is doing. So for myself, example, being down here in Florida, I may need to fly back to the office at least once or twice a month for key team meetings or key meetings. And interestingly enough, there are other folks within my same organization who maybe are coming in at least once a week. And that's purely a function of the demographic and the mix of junior and tenured staff, right? And so one of the reasons I'm coming in once a month rather than once a week is that my staff is pretty experienced and seasoned, whereas some of the other folks may have folks that are more recent college grads. And for that reason, they're coming in closer to once a week or more. And so I think we're seeing that the flexibility, even within following enterprise guidance for return to office, is really manifesting in each lead taking a look at the organization and thinking about their makeup of junior and more senior members. And certainly, I think that is driving not only how we're thinking about being in the office, but I think there's something to be said about, especially your younger actuaries who are early in their careers, there's something to be said about the benefits of just swinging by somebody's desk and looking at complicated spreadsheets and things like that, that maybe wouldn't apply as much for folks at management level or above, where a lot of that time is spent more in meetings and maybe perhaps email. So we are recognizing that challenge, Brent, and we are retaining flexibility within the business model to address that.
Yeah, I'll just add, you made a comment earlier about the ability of video conferencing today versus maybe where we were 10 years ago. And I think that's been a big help for us. We've had virtual happy hours. I think a lot of organizations have had some sort of virtual happy hours with their employees. We've actually had some of our employees that were remote pre-pandemic feel as though they're more engaged now because we've gone to more video conferencing, and so they can see their coworkers where maybe before we were either you were in a conference room or you were on the phone, and now we've moved to more video conferencing. So we've looked for solutions to bring people in virtually, but I will say I think some of the younger professionals are the ones that are maybe more hungry to be back in the office than others, and so again, we're happy to have folks back in the office, but with multiple locations, video conferencing is here to stay, whether we like it or not. So Alyssa, a couple questions here for you. So I'll send the first one here. Do you see the trend in healthcare costs? Do you see the trend of healthcare costs increasing? Any comments on major drivers in healthcare cost increase? And would you see the healthcare cost increase continue? And if so, for how long post-pandemic?
So as I kind of mentioned in my earlier remarks, one of the things I guess I would point to is, to the extent that utilization goes back to baseline levels, right, i.e. pre-pandemic, and in addition, we still have COVID on top of that. That is a big increase that the industry will see. And we're in the midst right now of trying to understand, like I said, how much of it is we're back at baseline plus COVID on top of it. Are we really at baseline yet? Or is some of that just deferred care that's being pulled forward? So I think that's the thing to keep an eye on as we move forward, and as we move through these next few months, and as we get into the winter, to see whether or not there's a future wave of the pandemic that comes. But I think it's that COVID on top of the non-COVID utilization, that is the real factor that the industry in total is keeping its eye on right now.
Another one for you here. Given that Oscar sells quite a bit on the exchanges, how has that business improved from a risk return profile in the past few years? Will there be continued innovation for those consumers that do not qualify for subsidies?
So I'm in the quiet period right now, so I'm not going to directly answer the first part of the question. But look, I think in general, the overall ACA marketplace is clearly continuing to grow as a result of just the Biden subsidies in particular, as well as efforts to educate people that this coverage is available to them, et cetera. And that's education by the government, by brokers, by healthcare providers, and by insurers as well, right? Everyone is trying to get people to understand that this coverage is available, because we are trying to close the uninsured gap that we have in the United States. I think the marketplace overall is becoming more stable, and that has over the years. And I think you see a lot more entrants coming, and actually some entrants, established companies that were in the very early days of the marketplace that left when it was less stable. We see them coming back in and into a number of the markets. So I think that is a positive outlook there. And I think, with increased competition, you will continue to see increased innovation. And certainly as products and plan designs, et cetera, become more innovative, those are really designed for not only consumers that come to the marketplace with subsidies, but those that don't necessarily qualify for a subsidy, or it's a very small subsidy. So I think you'll continue to see innovative plan designs. You see in the open enrollment that will be forthcoming, that there will be, every year there's more and more plans out there with virtual components that this was definitely spurred on and really took off as a result of the pandemic. You saw a lot more of those come out in 2021, and as well as for 2022. So I think you'll continue to see that innovation in the future.
All right, next question here. How are you measuring the effectiveness of plans implemented as a result of the pandemic? I'll take this real quickly from my perspective. Again, I think it took us a little bit of time, but within a couple of weeks' time, we did have everybody up and running at home. As Alyssa may have mentioned, we had quite a bit of equipment that left the office space during that time period as well. And so one of the challenges in returning people to the office was getting that equipment back into the office. So we still have some challenges from a telephony standpoint in getting our call centers more flexibility to operate between the office and between a home environment. If we ever had to go back to that situation, whether it be a pandemic, whether it be winter weather here in the Midwest, is another reason we tend to send people home. So there are still some things for us to work on, but again, we've been pretty effective in running business as normal over these past 19 months. Roy, anything from your perspective?
Yeah, I'll first mention, qualitatively, there's the question of, can we do the work that we were doing before in a virtual environment? I think it's pretty much a resounding yes here at Pru, and I'm sure that's probably a similar answer to most of our competitors. But I think one metric that's important is just the IT component. And Brent, you alluded to this before, but bandwidth being a concern, right? Especially early on. The question is kind of a parallel to manufacturing. When you think about injuries and time machines down, I mean, how much time are folks actually working and not having computer issues or having issues connecting to meetings? And I think the general effectiveness of workers being able to work without having technological challenges, I think that's one key metric that folks can index on, at least on a quantitative level. And again, I use that parallel to manufacturing as well, just because, you know, folks not being able to do their jobs due to any kind of constraint, whether that's injury, whether that's machine is down, or here in the financial world, our computers not working properly or the bandwidth not cooperating. You know, I think simple metrics like that measure the effectiveness, certainly.
Alyssa, anything from your seat?
I don't think anything. I mean, I think, you know, the metrics that you would have typically been measuring, right, in terms of like if you had a call center, right, the way in which people were being serviced, and clearly in those types of environments, you have metrics where you're monitoring how quickly the phone is answered, how many complaints you're getting, whatever the case is, right? Keeping an eye on those traditional metrics and making sure that they stayed within the bounds of what it was that you had when you were in the office versus how it was working when you were away from home was something that was definitely done. So I think utilizing a lot of your business efficiency or other types of metrics and making sure that you didn't have a change there would be one other way in order to measure the effectiveness of whether or not your plans are working.
All right, thank you. I don't see any other questions out there right now, and we're getting pretty close to our time limit here. So Roy, Alyssa, I want to thank you both for joining us on the panel today. And again, I want to thank everybody for joining us here at the first Drake Risk and Opportunity Forum. And with that, Kevin, I will turn it back over to you.
Marvelous. Thank you, Brent, Alyssa, Roy. Appreciate your thoughts, comments, and insights as we've all gravitated through this challenging environment. Kind of bringing things together in our next session, it will touch on cybersecurity. And so we'll be seeing what can we do, what has been done, and what is still coming in the future towards us. So with that, thank you to Brent, Roy, and Alyssa. And we'll be starting again at 20 minutes past the hour in about 7 or 8 minutes. Thank you.